Question number 13. Cost of equity will always be higher than WACC. Is this true? And the answer is yes. Equity is always more expensive than the cost of debt. WACC is combination of debt and equity. Equity is pure equity. So the cost of equity, remember, number one, cost of equity or equity is always more expensive than debt. Equity will also be more expensive than your WACC or WACC. Why is that so? Why is that so? It is for two reasons. It is for two reasons. Reason number one, debt, on debt you pay interest, and interest, as we have discussed earlier, is always tax deductible, and therefore even though you may be paying interest at the rate of 10%, effectively, because your tax rate is 25%, effectively your cost on this debt is going to be 7.5%. So that is one reason as to why debt is always cheaper than equity. That is one reason why WACC or WACC is going to be cheaper than the pure equity. That's reason number one. Reason number two, in case of debt, the lender is not taking much of a risk. In case of debt, lender is not taking much of a risk. Why he is not taking much of a risk? Because a lender will always mortgage all the assets of the entity in his favor to secure his debt to the company. And therefore, since he is taking much less risk, his cost to the company is also much less. The equity holder or the shareholder is taking much bigger a risk, because a shareholder, he is completely unsecured. He is completely unsecured. In case if the company goes in for liquidation, he is the one who will get his money in the end. If anything is left, then only he will get his money back. And therefore, the risk which the equity shareholder takes is much bigger than the risk taken by the lender. And obviously, when as a shareholder, as an equity holder, when I am taking much bigger a risk, my return expectation is going to be much more than the return expectation of the lender. I am sure you would agree with me on this, because a lender will be happy with if the lender is happy with a rate of return of 10%, I as the shareholder will definitely expect a return which is much more than 10%, because I am taking a bigger risk. And therefore, answer to the question number 13, cost of equity will always be higher than the WACC or higher than the debt, and answer is true. Question number 14, why COE is always more expensive than the cost of debt? I think I have already answered this question. Why cost of equity is always more expensive than the cost of debt? Because the lender is taking much lesser risk than the risk which is taken by the equity shareholder. And therefore, lesser the risk that you take, lesser is going to be your return expectation. Higher the risk that you take, higher is going to be your return expectation. Lender is secured more often than not, his risk is less, so his return expectation is much less. Equity shareholder is not getting any security whatsoever, he is taking much bigger a risk, and that is why cost of equity is always more than the cost of debt. What is capital asset pricing model? Question number 15, we have discussed it already. Question number 16, what is beta? We discussed, I think, yesterday as well as day before yesterday. What is beta? Beta is an indicator of risk. Indicator of risk. It is a covariance between the return of the market and return of the company. So beta tells that what is going to be change in the return of the company consequent upon the change in the return on the index or return on the market. So if beta of a company is 1.5, if the market is increasing by 1 point, the company's return will increase by 1.5 point. If the market is going down by 2 points, the company's return will go down by 3 points because beta is 1.5. So that means if beta is 1.5, that means the company is more riskier, and therefore the return will also vary accordingly, and that is what is your beta, that is indicator of risk. Can beta of a company be negative?